No. Hi, everyone. Welcome to MC the Accountant Shares. And we will have for this session the continuation or part two of IFRS 15 revenue from contracts with customers. So last time, or in the last video, I discussed to you about the steps. But then I started with the overview, objective, scope, effective date, terms, and the revenue model. So I also showed you this one. We are done with step one, identifying the contracts with the customer. So which of these contracts in which IFRS 15 would be applicable? Then step two is we need to identify the contract obligations or performance obligations. So after that would be steps 3 to 5. Now, for step 3, which is to determine the transaction price, we just have to remember that the transaction price is basically the amount of consideration in a revenue contract. So this is in exchange of the promised good or service. So the performance obligation could be the goods to be delivered or the service or services to be performed. And then it is also part of the contract as to the terms, meaning is it on account? Is it cash? If on account, is it evidenced by a promissory note? If with promissory note, is it interest bearing or non-interest bearing? If interest bearing, remember the face amount of the note is also the present value. So to get the interest, we simply have to multiply face amount or value times the rate times time. And then if non-interest bearing, so same formula, however, the face value is the present value in which we are going to discount the cash flows associated with the note using a discount rate. And then if the transaction price has or is variable, meaning it has a variable amount, so we need to estimate that amount. As being said, I told you that, for example, there is a rate for the interest. So in that case, the amount of interest is not part, by the way, of the transaction price. It is here, the adjustment for the time value of money for the effects of financing, if present and significant to the contract, that is to be made. So there has to be an adjustment if significant. So this is the reason why the short-term receivables are normally, or the short-term revenues, of course, that's going to be the same. Debit to receivables, credit to revenue, they're going to be the same. It is because one is debit and the other is credit. Anyway, so for the time value of money, the short-term receivables, the amount would be same as face value. It's because should we discount, the amount of discount is immaterial. So by the way, discount or that is actually because of the time value of money, that is an earned interest. Anyway, so an earned interest income, so it seemed to be a discount, but it's not really a discount. Discount is different. So the interest there, which is unearned for the meantime, and it becomes earned as time passes by using effective interest method, which will be discussed in other sessions. So in that case, the difference between the face value and the present value, it seemed to be a discount, but it's not again a discount. It's the unearned interest income. So that will be considered if material or significant. However, for short-term receivables, it's not. That's why we do not compute the present value of short-term receivables, which are non-interest bearing. Of course, interest bearing notes will not be discounted. Okay, so we have here also the examples in which the consideration becomes variable. So the variable consideration, if an entity's right to consideration is contingent on the occurrence of a future event. Okay, that's true. So this becomes variable because of certain happening, contingent, meaning dependent on the occurrence of a future event. So it depends upon the contract. That's going to make it variable, meaning whatever was the initial amount could change later on. Remember contract modification, so that can also change the amount of revenue. Anyway, so here is a certain sentence though that the variable consideration is only included in the transaction price to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. So quite technical, but the point is that initially the amount of the variable consideration, or let's just say the consideration portion of the transaction price that makes it variable, the amount of that will be determined with the happening of a certain event. So for example, for a discount, if the customer will avail of the discount, so that's the time that we are going to give the discount. So meaning it's going to depend upon the availment of the customer. So if ever that is to be resolved in the future time, if at this time, point in time when we determine the transaction price, it is highly probable. So highly probable is even more than probable. Remember I told you in the previous session that probable means that or probability means that the possibility or likelihood or chance of something to happen is greater than the chance, the likelihood or possibility that it will not happen. So in other words, the chance to happen is 51% up. Highly probable, some books would say 95%, but it's going to be a case-to-case basis. So if the significant reversal will not happen, and that is highly probable when the uncertainty that the said occurrence or event will be resolved in the future time. So meaning at time zero, we are able to determine that, oh, we have the high probability that it will not reverse at that particular time. So that's the point here. So in that case, we are going to include the variable consideration in the transaction price. So here are some examples: discounts, refunds. So probably in a future time, when certain conditions will be met, we are going to give refunds to our clients. Then price concession. So price could change. By the way, the variability of consideration could go up or low. Remember in contract modification, this is here, this part, or was that? This one, contract modification, the price will increase. So that's a possibility for variability of consideration. However, it's not going to be all the time. The price can go up or low. Performance bonuses, rebates, this is normally what is given to loyal customers. So if they're able to purchase this amount or range, then they are going to get certain percent. Then if it goes to another level or range, there is another percent. Then credits, incentives, and penalties. So even penalties, for example, if the customer cannot pay on time, so there is an additional amount. So in that case, that's going to be a plus to the price. I repeat, the variable consideration can be a plus or minus to the overall transaction price. Okay, so here is an example given by IFRS 15. In this particular problem, the company is Big Bed. Big Bed sell beds to their respective customers. The beds are priced at $400 per bed. By the way, if you are watching this, you can just pause me at this point and you can read the problem for yourself. As for me, I was able to read already the problem, so that's why I can go over with the details. Okay, so you can just pause and play if you would like. So $400 per bed on the price, and that is on the 1st of January 2017. Now, if the customer purchases more than 1,000 beds in a calendar year, the contract states that the price per unit is retrospectively reduced to $280 per unit. So meaning there is a discount of $20. $400 minus $280 is $20 reduction should the customer purchases more than 1,000 beds. So in other words, this makes the contract variable. So you might be thinking that there might be adjustment yet to the price. Well, we will have to consider it at the particular time that there is sale, just like in the second paragraph, that's 31st of March 2017. So we can now do the analysis that should we consider the discount? Remember this particular line here, this one up to resolve, that at a certain point during the time zero of the revenue, then we are going to determine if it is highly probable that the reversal of the cumulative amount will not occur or happen in the future time. So let us apply that particular phrase. As at 31st of March 2017, Big Bed sells 80 beds. Now remember, from January to March, that's 3 months. The company sold 80 beds. 3 months is a quarter, right? So we can estimate in a year, 80 times 4, that's 320 beds. That's why if this is like the sale all throughout the year, we'll assume it's going to be smooth or same or similar. So in this case, it's going to be 320 beds. Therefore, not able to reduce the price. No discount shall be given by Big Bed or the company. Okay, so that it's, or this is placed here. So to compute the revenue, that's 80 times $400, that is $32,000. So if we will be asked how much is the revenue at 31st of March 2017, that's going to be $32,000. Next. At the beginning of June 2017, the customer acquires another company, and at the end of the second quarter, 30th of June 2017, Big Bed sells an additional 500 beds. Take note, this is not from January 1. This is additional. So 80 times 2 is, how much is that? That's going to be 160. 160, and then that's going to be the amount for that 80 beds, good for the 2 quarters. And then plus the 500, it's going to be up to June 30, 2017. We estimate that the company can sell 660, right? So that's half a year times 2. That's going to be, how much is that? We can compute 660 times 2. That is, for a while, that's 1,320. Okay, we can do that. Or we can also have 80 times 4. That is 20. Then 500 times 2, because 500 is like half a year. That is 1,000. So 1,000 plus 320, that's 1,320. Okay, you might have your own ways of computation of the total sales for the year, but the point is that it should reach 1,320 units, approximate. So in that case, it's going to be the part wherein we have to consider a variable consideration. Please also take note that, remember, at the end of the year, that's going to be Christmas season, it's possible that people would be buying more. So it's even a possibility, though not highly probable, that they will be buying, or the customers will be buying more. So it can be more than 1,320. But with that, it's clear that we are able to exceed the threshold of 1,000 beds. Therefore, there should be a retrospective reduction of the price per unit. So if you multiply, or if we multiply the amount of revenue that is from June 2017 sales, that's 500 times 400 units, that's 200,000. Now we are going to consider a reduction of the price. Remember, in the previous or past quarter, we actually presented the revenue at $400, but it should be reduced to 380. Therefore, there is a 20 pesos discount or reduction of price. 20 times how many units? That's 80 units or beds in the previous quarter, 1.6. So 200,000 minus 1,600 is 190. What is that? Okay, so 198,400, but then there's also a reduction of price in the second quarter, which is 500 beds times 20, so 10,000. 198,400 minus 10,000 is 188,400. Or we can simply do the computation here. I might make the long method, that is 500 beds times $380, then we deduct the 1,600 reduction of price in the previous. In this example, we reduced the price for 500 beds automatically. So that's why, as for me, I presented like two discounts, the 10,000 and the 1.6. But still, the net revenue that we are going to present is 188,400. So the overall revenue then, if you will be asked like how much is the total revenue for the first half of the year, so 2 quarters, so that would be 380 pesos times 580 units. And that is 220,400. So how is that computed? That is the first part of the quarter up to March 31, 2017, that's 80 beds multiplied by 380. So that's 30,400. Then 500 times 380, 190,000 rather, plus 30,400 equals 220,400. Or we can simply compute it at 580 units total times 380 equals 220,400. That's going to be the total revenue for the 2 quarters. But for sure, we might be asked like, what would really be the adjusted amount of revenue in the first quarter and the second quarter? So for the first quarter, the lesson here is that the amount is really at 32,000 because there was no discount yet that is highly probable to happen. But at the end of June 2017, there has to be a reduction because of the change of circumstances. So what we can do is that we will do a retrospective adjustment. This is another lesson here. Okay, so I hope that is clear. I think this is like the part here that we will have more time or much time of computations. Okay, so step 4. Now, in step 4, we will be allocating the transaction price. Question is, when do we allocate the transaction price? It is when the items are in a bundle. As what I've said in the first session, there is a bundle if ever we have distinct goods and or services in the same contract. And take note, the word is distinct, so they are significantly independent from each other. They are capable of being sold, transferred, or because this is revenue, so probably sold or transferred or delivered and or separate from the other items in the revenue contract. Okay, so the transaction price as determined in step 3 should be allocated. Then How do we allocate? As a rule, relative standalone selling prices. If you are done already with property, plant, and equipment, probably you have already known acquisition of PPE items in a basket or lump sum price. So that is actually discussed here in the introduction, sale of non-monetary assets for PPE. When we say that PPE items are acquired in a lump sum or basket price, this basically means that for one price or consideration, there are multiple items that are acquired. So how do we allocate? Remember, we allocate the price using the fair values of the PP items acquired and develop fractions out of those. So the same, because the fair values of the PPE items acquired are their relative standalone selling prices. Should we acquire them separately, those are the prices. However, there might be some situations that the standalone selling prices would not be available or directly observable. Although under IFRS 13 fair value measurement, there is a rebuttable or a presumable assumption that the fair values can be determined. But take note the words where rebuttable, presumable, in other words, there might be exceptions to the rules. It's possible that we cannot obtain. So here are some options that are suggested by IFRS 15. In this case, we're going to use adjusted market assessment approach. In this particular point or part, this is where we are going to use the net realizable values or estimated market values. Since we cannot determine the fair values, we use the estimated ones. The second or third overall is the cost plus a margin. So remember, how do you make price or prices? It would be cost plus the markup. So example, the price that we want to would be 50% of cost. So if cost is 80 plus 50% of 80, so that's 40. 80 plus 40 equals 120 pesos. So that amount will be used as the selling price in allocation. And finally, which is not really allowed, which is like almost abandoned under the new revenue recognition model, but it is allowed only in very limited circumstances. So sometimes the price may include a discount, and this discount is allocated between the performance obligations on a relative standalone selling prices or price basis. So how come that is? When we allocate the transaction price, it's possible that the amounts would not be the same as their separate or relative standalone selling prices. In that case, the difference would be a discount. So let's do that in an illustration. Here you have three products by Fashionable. This is the company, a fashion outlet. So you have scarf at $40, shoes $55, handbag $45 for a total of $140. So these are their relative standalone selling prices. Now, Fashionable regularly sells scarves, shoes, and handbags individually. So that's why we have again the relative standalone price, selling prices or prices. And then if Fashionable would sell shoes and handbags together, they will be sold at $60. 55 plus 45 is 100. If shoes and handbag will be sold together, you will sell them at 60, or the company will sell them at $60. In that case, there is a discount of $40, which is okay. When we buy items in a bundle, normally we get discount. Okay. Then Fashionable enters into a contract with the customer to sell all of them at $100. So $100 from 140 original price, if all, there's $40 discount. Now, I'll just emphasize that this $40, it just so happened that we have the same amount of discount when I compared $60 with the total here amount, 140, $100. $140 is for overall. So I repeat, when I compared rather the $60 for shoes and handbag, then their combined price, which is $100, the difference is $40. It just so happened that it's the same as $40 when I compared $100, the three of them, and the $140 overall. Anyway, so however, because Fashionable regularly sells shoes and handbags together for $60 and scarves for $40, it has evidence that the entire discount should be allocated to the promises to transfer shoes and handbags in accordance with paragraph 82 of IFRS 15. So by this one, you can notice that there is now a connection. When the three of them are sold at $100, the $40 price of scarf is the same. So the 60 difference is really for the shoes and handbag together. And that's why there is $40 discount. That discount should only affect the items in a bundle. If you can notice, it is stated here that the $40 discount is allocated to shoes and handbags using these values, but we did not include the scarf. The scarf is the same as $40. Why? Because it is not part of the bundle. Okay, so the bundle is on the shoes and handbag, and that's why we are going to allocate. So how to allocate? Again, make use of their relative fair market values. That's 55 plus 45, that's 100, and develop a fraction, 55 over 100 and 45 over 100. So you multiply that with $60 and you will get $33 for shoes and $27 for handbag for a total of $60. Where's the discount? Remember, shoes is at 55. Now it's at 33. So there is 22 pesos discount. For the handbag, that's 45, 27, that's 18, the difference of the two. 22 plus 18, that's $40, which is the overall discount. I hope that is clear. So again, the reason is there is really a discount that is going to be there or to be given by the company which is fashionable should there be sales in bundle. That is a marketing strategy in business. That is our way to attract more customers. So aside from quantity discounts, there can also be like in bundles. So normally this is also done on the business perspective because accounting is the language of business. So this can be done also, especially if there are some items that are not saleable. So we pair them with items that are saleable. So we can already dispose of them. Anyway, hopefully you are still following for step 4, which is allocating the transaction price. Then step 5. For step 4, I might release another session or episode for IFRS 15. This is going to be part 3 about this one. How do we allocate based on the different situations? But for relative standalone selling prices, we already have one. This one. Okay, step 5. Recognize revenue when a performance obligation is satisfied. So when a revenue is recognized, it should be that it is also at the same time that an obligation or performance obligation in the contract is satisfied. There are two ways. It's either over time or at a point in time. But before that, when do we normally consider that a revenue is there? When there is a satisfactory performance of an obligation. Okay, that's true. How? If we transfer the promised good or service or goods and or services to customers. when control is passed on. So control is when we have the rights to enjoy or reap the benefits and rewards of the contract and bear also the risks and sacrifices in the contract. So it's not only going to be positive, but also negative when we say control. So if we are able to do such, so satisfactory performance of the obligation, transfer of the promised good or service, passing of control, or we would say that there is a substantial portion of control that is passed on, not necessarily the 100%, or there's also relinquishing substantially the management control. Okay, that's another way of saying it, especially with the old standard, which is IAS 18 revenue. Then control of an asset, this is what I've said. So we have the right, the ability to direct the use of and obtain the benefits. But as what I've also said, it's not also or only the benefits. We also include here the downside, which would be bearing the risks and also embracing or accepting the losses. Okay, so how do you recognize revenue? It's either we are going to do such over time or point in time, or this can be said not just how, but when. When do we recognize over time or at the point in time? So over time, meaning if we have years in a contract, let's say 10 years, then we are going to recognize revenue as a minimum. Under IAS 1, we prepare annual financial statements. We can also prepare monthly, quarterly, or semi-annually. So as a minimum, we are going to recognize revenue over the 10 years. So that is over time. That is based on simultaneous receipt and consumption of the benefit. That is also when there is creation or enhancement of an asset. Also, when the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right to payment for the performance completed to date. So there is no additional work then that is made. So that is over time. All right. If it is at a point in time, meaning at this particular point, let's say after a certain number of days, months, weeks, or years, there's already 100% done delivery of the goods or services promised or services to be rendered. In that case, that is at a point in time, just like when a customer orders goods from us and we deliver to them, and then we relinquish the control, release the management control, and there is transfer now of the good or service. In that case, that's clearly at a point in time. This first one that is over time is probably applicable with long-term contracts, just like construction contracts wherein we are going to make certain assets that are in bulk or big, like buildings, or develop an area with many buildings, and then it's going to take us years. So we have to consider revenue as a measure of progress that is over time, meaning a percentage of completion. So much will be discussed that in construction contracts discussion or long-term construction contracts. All right, so here are the contract costs. In determining the costs in a revenue contract, we are going to include only the incremental costs. So when we are going to sell our products, remember, we are going to spend or sacrifice money for such. Otherwise, we will not be able to perform the obligations. So take note, the word is incremental. Incremental on the sense that we are going to talk about additional, extra, marginal costs in the contract. So these costs would not be incurred had we not entered into a contract. Example of that is sales commission, but a practical expedient allows them to be expensed if the period would be 1 year or less. So there's no need for us to really put them as part of the cost in the contract if it's just short term. So meaning long term as a rule. but it is a practical expedient, meaning it is an option. Just like remember in the first part for analysis, individual contract, there is practical expediency concept of portfolio basis provided they have similar characteristics. So in other words, that is just an option, provided we comply with the requirements. So here's an example in which the costs incurred, the analysis is that the 10,000 will be considered incremental. The legal fees and travel costs are recognized as expenses because they are going to be incurred regardless of whether we are able to really pursue with the contract. Okay, that is why. External legal fees, travel costs, yeah, so not yet sure about the outcome of the contract, but when we pay the commissions, clearly that is an item that is to be considered incremental cost because it is related to the contract. Had we not entered into a contract, then we would not pay with such. Okay, cost to fulfill a contract. So costs incurred to fulfill are recognized as an asset only if all of the criteria are met. So if you can notice, guys, from the very onset, we talked about all of them. So all items should be considered. The costs relate directly to a contract or to unanticipated. It is directly attributable, in other words. The costs are there to generate or enhance the resources to have satisfactory performance, and we are going to recover the cost. There are some examples. So we need labor, we need the cost of the workers. This is really a concept in cost accounting. So others are done with cost accounting. They know these things that for us to finish the products or to be able to produce our goods or services to be sold or rendered to our customers or buyers, or consumers. So we are going to spend for salaries, materials, then overhead, both fixed and variable. And then those that are explicitly chargeable to the customers. So we are able to really recover them, or we will be recovering them. And those incremental costs which are directly attributable to the contract. Now, it's possible that an asset will be recognized with regards to the above cost if, again, here, if we are going to amortize them, meaning we are going to divide the cost over the period if it is more than 1 year. Okay, for presentation, it's possible that we are going to present an asset or a liability. So an asset, if we are on the part of the seller, so this is going to be a receivable, the partner is going to be revenue. Liability, if it is unearned, meaning it's not yet able, or the company is not yet able to release the obligations, or the performance obligations are not yet rendered to the customer, or control is not yet relinquished, such as when we received money in advance from our customer and no goods are delivered yet and no services are rendered. So in that case, there has to be a contract liability. So debit cash or any asset received, and credit and earned income or revenue. Okay, so that's it. We will only debit receivable when there are unconditional rights. There has to be a conditional right when we just receive the money in advance because we still have to perform the obligations or the performance or contract obligations. Okay, so it's also possible for us to recognize receivable even if we do not receive money yet, especially if the sale is on account, either evidenced by a promissory note or not. Okay. Then these are also some items that we have to take note, that for contract assets and receivables, they may be subject to impairment under IAS 36 impairment of assets if they are long-term receivables, and they are not presented using fair values. Then the difference between initial recognition of a receivable and the amount of revenue should be presented as an expense. Okay, for disclosure requirements, so these will serve as our checklist. We can actually check the information, whether qualitative or quantitative, about the following. So we are going to read, or you can just read them, but the point is that these are going to be additional information to be made or presented on the financial statements about revenue contracts. Disaggregation into categories, we are going to group them into similar items. So for example, if you have a lot of contracts, there can be contracts about just the retail. There can be contracts about another type of sale or another type of sale. So we have to disaggregate the whole, like the sales or revenue presented on the income statement should be shown in the notes to financial statements. So balances of all items, so receivables, assets, all liabilities, revenues, performance obligations, description. So probably what are these performance obligations to be performed, and the details, the terms, the nature, then obligations. So the variable considerations that we have tackled a while ago here, these items should also be disclosed. Then the types of warranties and related obligations, especially if we talk about gadgets, so very expensive items, we provide as sellers warranties to our customers. Then transaction price allocated. Also, if there are significant judgments and changes to be made, especially with retroactive adjustments, you also have to disclose. With the assets, then descriptions, the closing amounts, and the amounts of the amortization. So the cost of the asset or any asset recognized divided by the period that such would be amortized, and then the impairment losses to be recognized. And as last part, we have the transition. So as what I've said, with this standard, so the effectivity date is set already or has been slated as 1st of January 2017, but other IFRS countries would be following such on later dates, probably. So in that case, like Philippines, so in that case, there would be transitional provisions. So it's possible that when the contracts are still existing for more years, like long term, more than 1 year, we are going to make retrospective adjustments. So I've already discussed this to you guys. Then using individual contract basis. Under the alternative transition method, the restatement is not required, but the cumulative effect of initially applying IFRS 15 should be recognized as an adjustment to the opening retained earnings. So in other words, this is going to be treated as a change in accounting policy under IAS 8, which would require an adjustment in the opening balance of the retained earnings. Okay, so that's it, guys, for IFRS 15. This is the second part. Hopefully, you will still follow me on the third part, examples on allocation of transaction price to the performance obligations. So don't forget to like this video, subscribe to my channel, share this video to those people whom you believe would appreciate accounting more or learn accounting more in the easiest way possible. And I'll see you next time. Bye.